Welcome to your market brief for the week of March 2nd. U.S. stocks are coming off the worst week since 2008. For analysis, let's start the week with Neuberger Berman's Charles Cantor, who serves as a senior portfolio manager overseeing a collective $4 billion for the firm's long, short, and Guardian funds. Charles, great to have you with us today.
Good morning.
So it's been a wild ride so far. What are you advising your clients amidst the carnage that was last week and with uncertainties still surrounding the coronavirus?
Look, the first thing is you can't guess tomorrow. So I think this environment probably gives you a unique moment in time to understand your risk preferences. You haven't had that moment in a while as you've grinded higher over the last 12 months or so. So check in with your asset allocation, check in with yourself, and stay in the markets if you can, because time served in the market cures all ails.
So you can't guess tomorrow. Really, with the futures right now, we can't even guess today. At this point, futures suggest the worst isn't over. But are levels depressed enough at this stage that you see it as a buying opportunity?
I think it depends on your time perspectives. And I think if you have a 3 to 5 to 10 year time perspective, I think you'll come back to that moment in time and realize you got paid incredibly well for taking the risk at this moment. It's not about picking bottoms. I think it's about finding quality companies that can grow through this environment, recognizing that at this moment there's likely to be somewhat of an air pocket. Look, dividend yields are meaningfully greater than 10-year treasury yields. That's not a permanent state of affairs, and over time that gets resolved as well. So it's not about picking bottoms, it's not about guessing, it's about being disciplined, knowing your companies, having a process, and staying true to one's asset allocation at the individual level.
All right, I want to ask you about the Fed because there's a lot of talk that the Fed could cut rates even before its next meeting. Is that the right move, and what would that do?
I think the bond market's already pricing in about 100 basis points of Fed cut just this year. I think the Fed's telling the world that they're there to manage this volatility. Ultimately, it comes down to decision making and capital allocation. And decision making is really difficult for corporate executives in this environment. No doubt they're pausing, they're canceling trips, they're only allowing essential travel. But the Fed's there to provide the liquidity necessary to keep the financial system together. I think in 3 months' time, you'll have a very, very, very different narrative. It'll be different. It'll probably be around politics, not around health. And by that point in time, I think folks should hopefully feel better about the containment of this environment and a reminder that innovation will work, and don't bet against it.
But 3 months' time, I mean, how can you say that without really knowing the economic shock yet? I mean, what does the hangover from this look like, and does it involve a recession in your mind?
I think that's the big debate at this moment. Is this an air pocket, or does this create a recession? Recessions are defined as 2 quarters of negative GDP growth. My strong guess is it'll be an air pocket, not a recession. Don't forget that the U.S. economy is driven by the consumer. It's driven by services. It's 70% of the economy. And the U.S. consumer right now is in just phenomenal shape. Their jobs are strong. Their wages are up. Their balance sheets have been delevered. And so, yes, this will be a shock to confidence. I think it'll change how people behave in the very short time. So it's about behavior versus the science. But I wouldn't bet against the U.S. consumer over any long period of time, not from here.
Unless, of course, the consumer can't go to work because of the coronavirus. But I do want to ask you one final question. What do you make of the bond market amid these record low yields we've been seeing? I mean, what's it telling you right now?
Look, we look to the bond market to assess risk. We think bonds lead equities. And the bond and especially through the lens of credit spreads. So credit spreads have widened about 150 to 160 basis points. Back in January of 2018, credit spreads widened about 200 basis points. The one difference between now and 2018 is yields in aggregate are about 125 basis points lower. And so our guess is, spreads will widen maybe another 50 basis points. But for us, when you think about the overall yield, I'm not sure it's overly attractive relative to a return. So that'll be an assessment for individuals to make. But the bond market's scared right now, especially through the lens of the high yield. And I think what's especially important is this. I think equity folks will look through the slowdown if it's a slowdown, meaning they'll accept the idea that for 3 to 4 months, profits and cash flows will be much lower than they would have otherwise been. Again, depending on the nature of the company.
Thanks so much for joining us, Charles. Really appreciate your insights. Now, shifting to a preview of the week ahead, 1/3 of Democratic delegates are up for grabs as 14 states vote on Super Tuesday. On the economic calendar, Monday we'll get the February Purchasing Managers Report on manufacturing. On Thursday, OPEC begins 2 days of meetings in Vienna with Russia also in attendance. Oil demand forecasts have been slashed as a result of coronavirus, but the cartel has not reached a consensus on cutting production. Additionally, we'll get the U.S. jobs report for February on Friday. Expectations indicate that the unemployment rate will remain steady at 3.6%. On the earnings calendar, we'll hear from Target, Campbell, Zoom, Costco, and Kroger. We'll, of course, be listening closely to guidance amid coronavirus concerns, specifically when we hear from Zoom. Despite a dip last Friday, it's been one of the few bright spots in the market. Year to date, Zoom is up 50%, and businesses may increasingly rely on employees working remotely amid the outbreak. Sticking on that positive note, I'm joined now by Al Root, Barron's senior writer. Al, great to have you with us again. I want to ask you about your picks in terms of resilient stocks. So kind of value aside, what are some of your picks that may show resiliency amid these very uncertain times?
It's a good question. You know, I think when you look at any of these stocks, you have to think in terms of not overreacting. You know, coronavirus as a long-term investment theme hopefully won't be necessary. But you look at consumer staples, you look at some healthcare names, three that I like. You have Clorox, which is a consumer staple, makes bleach and things like that, has been doing relatively well. The stock yields between 2 and 3%. Gilead, again, it's a coronavirus stock, has some phase 3 trials for coronavirus treatments that they announced last week. That stock, but also trades at a below market PE ratio, yields between 3 and 4%. And then a company like Campbell's Soup, again, another consumer staple, but there's other things going on at the company. A long time ago, there's a prominent battle with Dan Loeb. He now has 2 board seats in that company. He's in turnaround mode. So those are 3 traditionally haven sectors or stocks that people can look at when things get a little rough.
All right, so what about companies that can thrive in an environment where people stay at home, like a Peloton or a Netflix?
Right, you got Peloton, Netflix, Zoom video communication, which I know came up recently.
That.
So there's stocks like that. But again, I think that it has to be just a small portion of your investment thesis and not the lion's share. I think the best advice might be if you're that worried where you're looking for Peloton and believing that people will just stay home and ride their bikes, that maybe you should just take your overall market exposure down.
Or stock up on some Campbell's Soup. But
yes.
One area that does particularly well during times of recession is spirits, alcohol companies. Mm-hmm. Is that going to be the case, do you think, during a time of a coronavirus outbreak?
Well, unbelievably, there's been a lot of internet memes saying that people have been avoiding Corona beer because of coronavirus.
38% of Americans, I
38% of Americans. That was a tweet from CNN. I like to say that, unfortunately, for the internet, but it looks like Americans are a little smarter than that. It actually, that prompted Constellation Brands, which markets Corona in the U.S., to put out a news release on Friday that said, listen, Corona beer volumes have grown 5% over the last 4 weeks ending February 16th. So that's good for American intelligence, even if the internet, you are sort of secretly searching, are the two linked? But yes, they should do well. The problem is, like Mr. Cantor was just saying, is companies with high debt like InBev, Anheuser-Busch InBev, that makes Bud and actually Corona, they have a lot of debt. They missed earnings recently. That stock is off, I think, about 20% year to date. People will probably avoid that, but more because they're behind in hard seltzers and things like that for the coronavirus. A company like Constellation Brands, to your point, that probably should be a haven.
All right, so it's more company picking rather than sector picking. Al, great to have you with us. Appreciate your picks.
Thank you.
Before we go, you voted on where a $10,000 investment will net you the biggest gain over the next 10 years, buying shares of Tesla, Bitcoin, shares of Apple, or gold. It was another tight poll, but the winner with 33% was Apple. That concludes today's Market Brief. However, we want to hear from you. Comment below and tell us if you were a buyer amid the sell-off. If so, what did you buy? Biotech, gold miners, video conferencing services? Let us know. I'm Caroline Woods. Thanks so much for watching.